I'm Taylor Riggs in San Francisco. This is Bloomberg Technology. Coming up in the next hour, drone attack. The attack on Saudi Aramco oil plants puts the technology of drones back in the spotlight, and it's a reminder of how the technology is dramatically changing warfare. Plus, big week. WeWork starts its closely watched IPO roadshow, while Apple faces its biggest tax case in Europe this week. We'll have the details. And location, location, location. In tech and the ad world, so much of the advantage is about where the consumer is physically. But how does location technology in all of our devices square with data privacy concerns? We'll ask the Foursquare CEO. But first, to our top story. For many of the national security teams that monitor threats on the U.S., the apparent drone strike Saturday on the heart of Saudi Arabia's oil production facilities was the realization of their worst fears. The attack raised concerns by U.S. security officials and experts in terrorism about the rapid evolution of technologies that could have allowed these inexpensive devices to pierce Saudi defenses in a way that traditional Air Force could not, flying long distances to drop potent bombs. To discuss, I'm joined by Bloomberg's Ellen Levin, who covers drone technology for us. So, Ellen, I think my first question here is from a national security standpoint, how concerning is it that these relatively inexpensive devices, frankly, were capable of this?
Well, to back up just for a second, we're still not 100% sure exactly what devices were used. The rebels in Yemen, which took initial credit for the attack, said they used drones. Later, U.S. Officials said that they were, quote, cruise missiles and possibly drones as well. Now, obviously, a cruise missile is a kind of a drone, and I think at the very least what we're seeing here is cruise missiles used to be kind of the weapons used by large military organizations. But as the technology has gotten cheaper and easier to use, we now see kind of them merging into rebel groups like this. So, you know, very definitely this is kind of a boundary that's been crossed that's quite troubling.
Alan, going out, do national security officials just assume that more of this technology will be used in warfare?
Well, we've certainly heard that from the point of view of domestic terrorism. The head of the FBI recently testified that they consider this to be one of their top concerns going forward. But we know the U.S. Department of Homeland Security has also identified quote-unquote drones, so that's a big category here, but drones as a potential threat going forward. And the Federal Aviation Administration is looking at ways to try to track these devices better. So clearly the same is true, you know, overseas, where groups can sort of work on these things, you know, without being tracked by the FBI and U.S. intelligence. So it's definitely a concern.
Alan, besides, you know, tracking some of these devices, what sort of future regulation do you see coming down in response to this? Well,
there's a host of things. As real quickly on tracking, in the next couple of months, the government's about to propose requirements that every drone in the U.S. be tracked electronically. But beyond that, you know, they're also looking at better registrations. They're trying to create a low-level tracking system that will follow these kind of like radar does. But I have to tell you, the technology is tricky. They did some tests at airports, and it was very difficult to actually spot intruder drones. You know, sometimes radars see them, but sometimes not so well. And it's a very tricky technology problem. It's also tricky to how to take them out of the sky. You know, you can override their radio signals and that sort of thing, but that's tough in a civilian environment. So it's quite a tricky problem.
Tricky problem indeed. That was Ellen Levin. Thank you for joining me. Now, Apple fights the world's biggest tax case this week in Luxembourg. The iPhone maker will tell the European Union's General Court that it pays more taxes than any company in the world. That won't be enough for EU antitrust chief Margaret Vestager. She's ruled that Apple's tax deals with Ireland let the company pay far less than other businesses. For more, I want to bring in Bloomberg Technology's Mark Gurman. So, Mark, who has the upper hand this week, Apple or the EU?
You know, that's a very good question. I mean, I feel like Apple would not be sending, its CFO, Luca Maestri, and a team of, I believe, 6 people if it really didn't think that the EU had the upper hand. I think Apple's not coming into this from a position of strength. Their dealings with Ireland and having money in Ireland and having tax loopholes in Ireland to offset some of the taxes getting in other regions has been heavily criticized for years. The EU clearly has its position on this. Apple has its position as well. Recent history is any indication. Apple has really taken these things to court, but then settled pretty quickly. So I would not be surprised to see a few months there be some sort of meeting of the minds here between Apple and the EU in regards to this tax situation.
Mark, if there's not a meeting of the minds and we get a $14.4 billion tax bill, what does that mean for Apple's bottom line?
Yeah, I mean, it's $14.4 billion, a lot of money. I'd really like a check for that amount of money right now. But, to be honest with you, they'll find out a way to, sprinkle it across, several quarters and do different adjustments. And maybe they would take, debt out. They've been taking a lot of debt to pay that off pretty quickly. And of course, they have over $200 billion in cash off hand. So if any, company could take that bill, it is Apple.
What does this heightened tension between Apple and the European Union's commissioner mean for Apple's strategy in Europe? Are they less likely to want to be working with Europe?
I don't think this changes anything. Europe is a very important market, not only to Apple, but basically every global corporation. So they have these issues across different countries, right? In the US, they're dealing with the tariff situation. In China, they have this careful balance they're playing between local laws and what they want to do for their consumers in terms of privacy and products and services. And the EU, they have this tax situation. And what you're seeing here is just another one of those things that, as one of the biggest and most successful companies in the history of the planet, that they have to deal with. So I don't think this changes anything. I think you're going to still see them working on striking deals to get the Apple Card there and some of the other products that they're working on that they want to get global.
Well, we await some more announcements, of course, coming from that this week. That was Bloomberg Technology's Mark Gurman. Thanks for joining me. And coming up, WeWork's path to the public market has been quite the ride. Its impact on SoftBank and why backers of its vision fund are now having second thoughts. That's next. This is Bloomberg. The biggest backers of SoftBank's Vision Fund are having second thoughts. Bloomberg has learned that wealth funds in Saudi Arabia and Abu Dhabi are reconsidering how much to commit to its next investment vehicle in the wake of the WeWork fiasco. SoftBank invested in WeWork at a $47 billion valuation. Now there's talk the workspace leasing company might be worth less than a third of that in an IPO. To discuss this and what we should expect from WeWork's roadshow, I'm joined by Bloomberg Opinions, Shira Ovide, and here in San Francisco, Bloomberg Technologies, Ellen Hewitt. So Ellen, let me start with you. How much of a scar now do we think WeWork is relative now for SoftBank?
Well, I think we're starting to see that the fortunes of WeWork and SoftBank are even more closely tied than we expected. So obviously SoftBank has been a major backer of WeWork. Over the last couple of years, they've invested something around $10 billion in the co-working company. And now we're starting to see, as the WeWork IPO starts to get a little shaky, there are effects on SoftBank's ability to raise money for some of their investment funds going forward. So as we talked about, wealth funds from Abu Dhabi and Saudi Arabia, who have traditionally been major backers of SoftBank's enormous $100 billion vision funds, Vision Fund 1, and their attempt to start a second one, are starting to get nervous. So they're saying, we're not sure that we want to invest the same amount that we did in the first fund in the second. And those are ongoing discussions that we had some reporting about today. And so we're starting to see WeWork is having ripple effects beyond just their own IPO.
Shira, let me bring you in here. You've been writing some great articles about how SoftBank's sort of been this enabler to WeWork's fiscal irresponsibility. Does the fact that maybe backers in the second fund are starting to get a little bit more hesitant show that SoftBank's demand, frankly, is not limitless at this point?
Yeah, I think that's right. And look, I think the tensions, particularly between SoftBank and some of its investors, have been going on for some time. And WeWork, of course, is at the center of some of those concerns that you saw. The big Saudi fund, Saudi Arabia government fund, they had some questions about SoftBank pouring as much money as it wanted to into WeWork. And, our colleagues also reported a story a few weeks ago about tensions even inside of SoftBank between the executives who were very bullish on WeWork and wanted to continue to invest money into it, and others who weren't quite so sure.
Ellen, of course, we do know that roadshow sort of kicked off today. How do you think it's going so far? What are you hearing?
Well, I think we're expecting to have it this week. I think there's still some last-minute filings and final decisions that we're waiting for, but that is the expected path. I think if things go forward as planned, what WeWork is hoping to do is that they'll have this roadshow starting soon, and that they'll be able to wrap it up in time before the Jewish holiday, which is a time when their CEO might need to spend some time away from technology. But whatever the main reasons are, there is definitely pressure to try to get it done soon. And I think they're hoping that maybe investors will show some more interest in the stock now that they've made some governance changes. So on Friday, they had issued an amended S1 that, as we've discussed, reeled back some of the more dramatic corporate governance decisions that the company had made. And I think we still have to wait and see whether that's going to have any effect on the possible valuation of the company.
Well, Shira, it's very interesting because you've talked a lot about how changing those corporate governance structures that we just heard Ellen talk about, frankly, hasn't changed what's really wrong with WeWork, which frankly is its finances. Do you agree that maybe the corporate governance structure changes didn't go far enough, didn't do enough?
Well, I think it certainly helps, right? It addresses kind of one of the big question marks, or partially addresses at least one of the question marks around WeWork. But look, this is a company with a very short operating history. It is burning cash like crazy, so it needs a constant resupply of cash in order to survive. It owes something close to $50 billion, $50 billion with a B, in coming years on lease payments it's agreed to make. And again, this company has a short history and bleeds cash, so it's unclear how it comes up with that figure. It is still almost entirely in control of one person, CEO and co-founder Adam Neumann, and the company sort of made some questionable investments or spending decisions. So there's a long history of kind of red flags and question marks around this company. So it's probably good that they addressed some of the governance concerns, some of the powers of Adam Neumann, but it sort of only rolls back a few of them. And again, he's still firmly in control of this company.
Shira, of those big red flags that you just listed, what's the biggest concern?
I think it's really the financial dynamics. Again, this is a company that is growing very fast, but look how it got there, right? We don't know how much money, how much profit the company makes, if any, on buildings that it has subleased for a considerable period of time. It doesn't really go into any disclosures about the buildings that it's owned or that it's leased for a longer period of time that presumably have better unit economics. And again, this is a company with uncertain financial model, and it's on the hook for $50 billion in lease payments. So, the mismatch between the question marks around its ability to profit ever and the money that it owes, the cold hard cash that it owes in coming years, that's certainly a red flag for me.
Ellen, I think we were a little bit surprised that WeWork planned to go through with the IPO, go through with the roadshow, given SoftBank's hesitancy or perhaps pressure maybe not to. Any idea this week during the roadshow, when we start to see it kick off, how that relationship between WeWork and SoftBank may change?
I think it's still to be determined. You know, part of the interest in following this story has been trying to track this disagreement internally, I'm sure, within SoftBank, within WeWork, between the two companies, with some of the banks, about how best to proceed. And, you know, part of why WeWork is so interested in continuing forward with the IPO, or at least we have to imagine, continuing forward with the IPO despite reservations and hesitations from other parties, is because they really need this cash. And it's not just the $3 billion or so that they're hoping to raise in the IPO, but it's the contingent $6 billion of additional, you know, credit facility that they get access to only if they have a successful IPO that raises at least $3 billion. This is something you can read about in the S1. And so there's a lot at stake for WeWork to try to make something work, right? To try to see if they can move forward with a plan as had originally been discussed. So I think changes are still a possibility, but that's certainly, I have to imagine, not what they would hope would happen.
Well, we know that bondholders certainly have been the gauge, right, on how well they think that the IPO is doing. That was Bloomberg Opinion's Shira Ovide and Bloomberg Technologies' Ellen Hewitt. Thank you for joining me. And coming up, our exclusive interview with IBM CEO Ginny Rometty as she discusses Red Hat and the future of the company. This is Bloomberg. Ginny Rometty started at IBM in 1981, became CEO in 2012, and has overseen a dramatic repositioning of the company as the tech space continues to evolve and transform. The Big Blue exec has said that Chapter 2 of tech's evolution is centered around reinventing data. IBM has invested heavily in this notion, including last year's $34 billion acquisition of Red Hat. Bloomberg's Caroline Hyde spoke exclusively with Rometty about the growth of hybrid cloud and why it's unusual for competitors to also be collaborators.
This has always been something we have felt so true about. It's what the customer needs, is what you do first, right? And our clients. And they live in a world that you're going to have. For sometimes your innovation will come from Google, Amazon, Microsoft, IBM, and you're going to want to take advantage wherever innovation comes from. And that's actually the idea and the way the world is going. So on one hand, you want to build something once, run it anywhere. And the second part is you want to get to innovation wherever it is. And so, like in almost every business, you have competition and cooperation. And in this case, and again, when we bought Red Hat, because it's a platform that goes across all of them, absolute commitment. It's open source, the world's leader, to run, and it does run on those platforms, and absolute commitment to the integrity of that. And that's really for our clients.
Would you still see Microsoft, Amazon as competition? How do you make your name synonymous with cloud in the same way that they have almost become?
It isn't our name. We are the #1 hybrid cloud player now. And so that's what I want my name synonymous with. #1 hybrid cloud, best partner to help make you a cognitive enterprise. And that's a company that has got data and AI infused in all of the way it does its work. Because if you do that, you'll have to have a hybrid cloud underneath it. So I'm really about that digital transformation journey. And that means at times you'll work with me. And by the way, you'll have many clouds. You already have many clouds. Most clients, I've had so many, I'll say, how many clouds do you think you have? They'll say, 2. Come back. I have 7. I said, you don't realize what you have here. And so the idea behind that is connect all of that together. And then when you speak of just cloud alone, the IBM cloud, which is both private and public, I mean, we really are the best cloud for mission critical work because of the security end-to-end that's there and our ability to take mission critical apps, and you have to understand how those work. That is our sweet spot.
Are clients getting it?
I think I know they're getting it. So take an example, Delta, take an example of AT&T. AT&T, we just recently announced, it is to move all of AT&T Business, all of their applications onto the IBM hybrid cloud. And as well with Red Hat, it will be out into the network, so your network services come faster. And that is exactly what it is that we're able to do. Delta Airlines, a lot of work done with them on as you front end deal with your customers. Now, modernize the back end to connect those two. So when you rebook an airline, you'd like to have, not only can you rebook, every associated thing that a passenger would want done. And those are all those back-end systems connected to that real time while you're up in the air. So Delta, big, strong proponent of Red Hat as well. And so it's Red Hat and IBM, mission critical, hybrid, multi-cloud on open systems, so you get lots of innovation, and it's very secure.
Red Hat, 34 billion, amazing acquisition. You're someone who knew about acquisitions. You're someone who helped integrate, for example, PwC's IT consulting business within IBM previously. How are you ensuring that the integration can be as smooth with Red Hat?
Yes. Well, first off, a couple words. I don't think the word is, quote, integration as a traditional, and it's related to what you just asked me a minute ago. So Red Hat, as I said, is the world's number one open source company, and together we're the number one hybrid cloud provider. So when we acquired Red Hat, which, by the way, it is a very fair price. They are a very good company and very profitable company, which is not usually high growth, high profit, is not what you associate with some of a cloud company.
And not with the recent IPOs either.
So an outstanding firm built over many years. And IBM has worked with Red Hat over 20 years. We were the original folks that really helped propel open source onto the stage. We put $1 billion into something called Linux back then. Because the architecture of the future, it has been decided now. And I know these are, just not everyone is familiar with all the tech pieces of this, but it will be Linux. It will be this thought of containers on top and something called Kubernetes that moves the containers around. Just like you thought of the past, the internet and how it was run, this is the future architecture. I think that war is over. That is the architecture of the future. That is what Red Hat is, and they are the number one there. And so when we acquired them, we have two roles with them. I think of it as horizontal, vertical. On one hand, we are leaving them as a separate and distinct unit. And I have had plenty of experience, as you said. I've done 60 acquisitions in my time. And because, for a really important reason, they will participate and continue to be the leader in open source. So that's a very different community out there. They must remain committed and neutral to that. The second is they have to be on all our competitors' platforms. So I want them to see firm neutrality on that. So they will work and put themselves on all those platforms as they do today. And then what IBM does, so think of them as completely non-biased. IBM will be opinionated. So what we will do is we take their products, we make the best mission-critical cloud, private and public, and that's what clients need. And I have already built all my software to take advantage of theirs. So you can actually now take IBM's entire key software portfolio and it can run anywhere. To a client, that is a dream, to be able to renovate. All the mission-critical apps of the world are built on IBM. So we now own the origin, we own the starting point. The world is already more than half Linux, which is what Red Hat is, and then the destination is that architecture.
That was our exclusive interview with IBM Chair and CEO Ginny Rometty. Be sure to tune in all week at 2:30 p.m. Eastern for more of our extended conversation with IBM's Ginny Rometty. On Tuesday, they discuss IBM's push into quantum and what Big Blue is doing to attract talent from all corners. And coming up, California is looking to target ride-sharing companies and the rest of the gig economy with that new potential law, AB 5. We'll be discussing that next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. New California legislation impeding many companies from claiming workers as independent contractors will take effect in 2020. Named AB 5, the law passed the Senate and Assembly last week, and Governor Gavin Newsom has indicated he will sign it. So how will companies like Uber and Lyft, with many independent contractors, make out? To discuss, I'm joined by Steve Jang, founder and partner of Kindred Ventures. Steve, of course, is also an Uber shareholder, so you're the perfect person to talk about this. How big of a hit is it to those companies?
I think some of the estimates out there have been that it's anywhere from 20 to 30% in terms of the California operation for a lot of these companies. And it's larger than just Uber and Lyft. It's really sort of any gig economy marketplace. So that includes service marketplaces, and a lot of these companies have come about in the last 10 years. And they're involved in fixing appliances in your home, perhaps cleaning your office, and driving you or your family or your coworkers to and from their employment. So it's really sort of a far-reaching bill, and there have been a lot of exceptions applied into it as part of the political legislative process. So it's been an interesting thing to watch over the last few weeks.
Do you think Uber or Lyft might be hit more?
Yeah, I think definitely the service marketplaces will definitely see the hit, and they'll have to react to that. But the truth is that the process from here is still complex. So not only does the governor have to finally ratify that, but also it's sort of in negotiation right now with the governor. It's also in the companies have created a consortium that they funded to propose a bill for next year that will be voted upon. And their idea there is to provide a lot of the benefits that make sense and that keep the business running with as many participants in terms of part-time discretionary workers who want to be independent contractors, but to provide the minimum income and benefits to them. And so I think there's the end outcome here is that there's going to be a compromise where, frankly, a lot of these benefits and assurances should have been proactively proposed by a lot of these companies. Now the test is whether they can come to a good agreement and compromise and do something that's good for the participants, the people that are not only part-time and want that discretionary independent contractor work, but also the people that are working full-time and to provide something for both of them, yet keep the number of jobs available through these marketplaces and the end consumers happy.
How do you value a company like Uber? I was speaking with an analyst last week, and he said he actually values it like a social media company because you're tracking how many monthly downloads you have of the app. How do you value a company like Uber that's in so many vast different businesses?
Right, and it's a global business as well, so it has international coverage, but it also has multiple product lines on top of one platform. And so the core platform is called Marketplace with a capital M at that company. And what they've done so well is launched Uber Eats, Uber Freight, Uber Health, which is basically a very performant version of taking you to your doctor's office on a scheduled and on-demand basis. And so a lot of these businesses are built on the same exact matching engine. And this matching engine is not dissimilar from like a stock market, right? Like NASDAQ. And so the idea that this marketplace has multiple products, it does make it a challenge to identify the overall size of the business when you have so many different product lines growing at different paces and at different timeline beginnings. And so looking at it as a platform and then evaluating each product line is probably the way to go.
You mentioned Uber Eats. We should also note that you're an investor in Postmates, of which you were an investor at different times, that arguably now one might consider those competitors. That food delivery space is so competitive. How do you think Postmates can make it and outpace a Grubhub, a DoorDash, and Uber Eats, all of those big competitors?
Well, I think the Postmates and DoorDash were very early on and very focused on food delivery. Uber entered the market realizing that their logistics network and their drivers and their marketplace could be extended into different areas, and that a lot of drivers could also become food delivery drivers as well, and couriers. And so one of the interesting things about AB5 is that it really sort of affects a lot of different industries where there might be people working as a food delivery courier for one company and as a driver for another. For instance, a lot of drivers on Uber are also drivers on Lyft. And so with AB5 getting introduced, it really forces founders and management of service marketplaces to figure out how are they going to build a viable workforce that is now dedicated and committed like a full-time employee would be. The lack of choice will be introduced to those drivers, right? They'll have to work for one company because of the cost dynamics of what it'll mean for these marketplaces. And so when you look at some of the growth internationally, you see the map being divided by region, continent, and also by type. And so you're seeing cloud kitchens rise up in offering restaurants an ability to service all of these food delivery networks. And so a lot of things are changing underneath the surface, and it's really interesting to see. I think the ones that are very focused and try to create the highest margin through working with cloud kitchens and using a driver network where they can, like Uber does, I think those are the key advantages.
Another big story that we've been following really all within the last few months has been Peloton. You're not an investor in Peloton, but what about that company and that connected fitness makes it so successful?
Sure. You know, Peloton is interesting. It's sort of the first company that's been both equal parts hardware and media in the fitness space. You had prior companies that are public now, like GoPro and Fitbit. And Fitbit was a fitness tracker, right? Hopefully it would motivate you to do something healthy for yourself. And then GoPro was more about entertainment and fun and photo and video capture while you were doing something. Hopefully that was fit, right? And now what you see is something that is actually directly benefiting your health in terms of treadmills and cycles. The hardware revenue from that is not the only revenue, and actually the lifetime value of a member or subscriber to Peloton is quite interesting. It's $40 a month. It's more than most people pay for Netflix and Spotify. And so really it's a technology company as well as a media company, and it's providing for the end goal fitness. Now, the community around that and the services and the hardware you get from that, is it something that you can get from a gym? Yes. But a lot of people don't have the convenience of going to a gym easily. Some of them have families or live far away from an adequate gym. And so this is really the beginning of a long series of products. We're investors in a company called Tonal, which is doing this for strength training rather than cardiovascular fitness. And it gives you the power of a gym through software, hardware, and media to be able to be coached and trained in the comfort and convenience of your own home or apartment. There's a long list of companies that are happening in the private market right now. Like
you said, it's all about convenience. Thank you. That was Steve Jang of Kindred Ventures. Thank you for joining me. And now to a social media platform that upends conventional notions of what social media is. Consider photos with no public likes or comments, profiles with no followers, and it's still one of Generation Z's favorite social media platforms. VSCO is taking over, and co-founder Joel Flory spoke recently with Bloomberg's Caroline Hyde and Scarlett Fu about the platform's continued growth.
It's been a community where without likes or comments, we've created a safe space for people to be who they are. And with the VSCO Girl trend that we're seeing, this again is no coincidence or no surprise, but on the other hand, the scale of it has definitely caught us by surprise.
Let's just back up a little bit, because neither of us are Gen Z. I have a kid who's 13 years old, and he talks about VSCO Girl. But explain what VSCO is. You're an app that provides tools, but you're not a platform in and of itself, are you? So VSCO is a mobile app that helps you take professional quality photos on your mobile phone. And with that, we're providing high-end tools for photo and video, but making them accessible on a mobile device. The key component of it, though, is a community that we have that drives you with creativity around inspiration, education, helping you express yourself.
How many users now, and how are you seeing the growth accelerate?
So we have roughly over 20 million weekly active users, and the growth we've seen is really unprecedented for us. Since 2012, when we launched the mobile app, we've seen extreme growth. In 2017, we launched a subscription service. Last year, we hit just north of 2 million paid subscribers, and we're on pace to nearly double that this year.
So drill down a little bit more into that demographic, because we see pictures of VSCO girls, and it's become a meme, as Caroline mentioned. She has a scrunchie, she wears these bracelets, Pura Vida bracelets, has a hydro flask, a Swedish backpack, which I can't pronounce. What is the demographic breakdown? Where is the growth, if not the US, then outside the US?
Yeah, so 80% of VSCO's outside the US, and we see it from a complete global perspective. Wherever iOS or Android are available, VSCO's there. And so we see great growth in Asia and in Europe and in South America. And so really it's around creativity and expression. So what we see, especially with Gen Z, so 75% are under the age of 25 on VSCO. And what we're seeing is specifically as we talk to them, they're the first generation that has lived their not only their entire lives online, even before they're born, there's a digital footprint where parents are registering usernames on platforms for them. And they've lived this life under pressure and scrutiny, and what they're looking for is this outlet where they can be who they are, a safe space without likes or comments. And since the beginning of VSCO in 2013, when we built the community component, that's the way that we built it.
Do you think the individuals can remain in a safe space, remain authentic as you grow and grow and grow? Do you think that you're able to keep that novel element that you have compared to the likes of Instagram, and you're worried that they might just copy you?
Yeah, so why I think it's critical and so unique for VSCO is that unlike other platforms where specifically Gen Z, but others are also sharing how they want the world to see them, on VSCO it's about how you see the world. It's about your creative journey, your self-expression, and finding a safe space for you to share that.
Now, VSCO is unique in that you mentioned there's no likes, there's no comments. You don't build this business based on eyeballs at all. You're not tracking that specifically. Was that a hard decision to make? Because I'm sure lots of your backers would have said, this is the obvious way to go. You have a bunch of gigantic Silicon Valley companies that do that and do it very well and make a lot of money.
Yeah. From the beginning, VSCO's been about building a quality product that people are willing to pay for. So we started with the desktop plugin, then a paid app, then a free app with in-app purchases, and now a subscription base. And so VSCO's always been about paying for something.
How do you evolve? Is it you just follow Gen Z through their life cycle? Do you ensure that you remain relevant to the younger audience and keep on going? Do you think at some point they will depart you and spread their wings?
So our focus is less on a specific demographic or a really age group as it is a mindset. It's a mindset around investing in yourself. It's a mindset around that mental health is important and that creativity is an outlet for improving your mental health. And so we're helping people on that creative process and that creative journey of expressing themselves.
That was VSCO co-founder Jill Flory speaking earlier with Bloomberg's Scarlett Fu and Caroline Hyde. And coming up, we'll have a check-in with Foursquare CEO on the latest from the location-enabled technology. That's next. This is Bloomberg. Tech regulators continue to target social media companies when it comes to protecting consumer data privacy. But one tech company focused on user location has managed to stay under the radar. Joining me now, Foursquare CEO Jeff Glick. Jeff, thanks for joining me. You know, as we take a look at Foursquare, so popular when it launched, since then there has been a lot of competition. How do you stay relevant?
Well, it's great to be on your show. The company today is celebrating its 10-year anniversary, and we're very different, so much more than the check-in app that your viewers may remember. Now we've passed over 100 million in revenue. We're bigger than ever, and we're 99% really not social media or location check-ins, but a location technology platform that helps other companies with location technology, marketing tools, analytics tools, and the like. And so we're actually more ubiquitous than ever, but kind of like a location layer underneath, an Intel inside for location.
We talk more and more on this program about data privacy. How have data privacy concerns affected your business?
Well, Foursquare, because we started 10 years ago as a consumer company, had a head start in thinking about all the ways that location could make our lives better, but also all of the potential abuses and the privacy implications where consumers should be in control. And so we've been thinking about this and really trying to build an ethical tech company. And internally, we talk a lot about the ethics and privacy of approaching this stuff. And I know this day and age, that's unusual, but that is what we're about. So for us, it has been, in a way, a benefit to our business because we are hoping that developers and marketers are actually taking a really close look at how they add value with location, whether they have adequate user opt-in, whether there are user controls. We've been advocates, in fact, that there should be more regulation in the United States, not less. So for us, staking out a position where privacy and ethics are very core to what we're doing, we're actually kind of welcoming the scrutiny, and I actually hope there'll be even more.
That's very interesting, especially as we talk about sort of the impact on the big four and then how it's been translating down to your business. I want to talk earlier about one of the first acquisitions you've made of Placed, and this came after a big fundraising round of about, I believe, $150 million or so. Talk to me about Placed. Is it just a typical horizontal acquisition of taking out competition?
So we acquired, when we raised $150 million from a group of investors led by the Rain Group this year, we acquired from Snap, the parent of Snapchat, a B2B business called Place, which is the leader in measuring in-store visits after you have seen an ad, whether it's on TV or digital or on outdoor billboards and the like. So it helps marketers make better decisions about what's working and, as they say, which half of my marketing spend isn't working. We combine that with Foursquare Attribution, which was growing fast, and together we are the leader in helping marketers and product companies understand what's working. So we work with about 50 of the Fortune 100 in the United States, 14 of the top 20 retailers, 18 of the top 20 QSR and dining brands to help them understand which of their ads is actually inspiring new consumers or regulars to come back in the door in their storefront. And so with Placed, we really have taken a big leap forward in being the #1 by far in that space and added a bunch of very talented people, including our new president, David Shim.
Broadly speaking, there's been a lot of scrutiny on unprofitable tech companies, big tech companies that are trying to IPO who frankly look like unicorns who can't cut it down to the bottom line. Generally speaking, as you talk to your investors in the fundraising environment, is there more scrutiny on your financials?
Well, we've been fortunate for a while. Our biggest investors, Andreessen Horowitz, Union Square Ventures, and now Rain Group, have been really balanced all along. Fred Wilson of USV, who's been involved with the company from the beginning, is a big fan of companies having solid unit economics and a path to profitability because you never know how the economic cycles are going to turn. So we've focused a lot on growth, but also on making sure that we will be profitable at scale, and we have profitability in line. We're not profitable yet, but we're getting very close. And so I look at companies that have sort of irrational unit economics, and I think that's not what we're trying to do. We're trying to build a profitable, scaled business here at Foursquare, and that's the advice we've gotten from investors. The market still seems to reward, and we're a private company, high growth rates, and so you need to balance. You don't want to get to profitability at the cost of substantial growth. We're really in the first inning of what location technology can bring, whether it's not just to marketing, but to self-driving cars, to urban planning, to real estate. So we don't want to miss out on the global opportunity that's ahead of us, but we want to be rational about it.
Well, you stole the words out of my mouth. Path to profitability, it's my key phrase. Thank you. That was Foursquare CEO Jeff Glick. And still ahead, Lime celebrates its 100 millionth ride. We'll hear about its mission to be sustainable and affordable with the CEO. This is Bloomberg. The United Nations Climate Action Summit is due to be held next week, and most Americans agree that climate change is something that needs to be addressed. Bloomberg is part of the Covering Climate Now project, which includes more than 100 news outlets. CBS News, part of the project, recently conducted a poll which found that 2/3 of Americans, or about 56%, now believe that climate change is either a crisis or a serious problem. Lime Micro Mobility touts 100% renewable energy with the electric scooters and electric bikes that it operates. The company has recently surpassed its 100 millionth ride, and with more, I'm joined by Brad Bow, Lime co-founder and CEO. Congratulations on the 100 millionth ride. Is that really how you measure your success?
Thank you. I think we're very excited about 100 million ride mark, which we achieved like 2x faster than even Uber. So we're very excited about it, but this is not the only way we measure the business. We measure the business by the positive social impact that we make in the cities and communities that we're operating in. I think in addition to reduce the congestions and reducing the pollutions, the one thing we're super excited about is we're giving time back to the users. And for example, in Paris, the user reported they reduced 10 minutes in traffic by using Lime, and that's 20 minutes a day. That it translates into 8 days in a year that they can spend with the people they love or doing the things they love.
How are your conversations like with local regulators in a city where you want to enter and they say no? Well, how do those conversations go?
Yeah, I think it changed quite a bit in the last year or two. I think, again, that 100 million ride is just a milestone, a number, but it means a lot because it's a validation of cities seeing us now more so as solutions then hey, just another business. We enter every single market with the permission or contracts with the city. We discuss with them what their challenges are in terms of traffic congestions, pollutions, equitable accessibilities, and then we design the program together.
How is it about your technology that differentiates a scooter or a bike? Because let's be frank, a scooter and a bike wasn't invented yesterday. What about your technology makes it different?
The technology we deploy to really make a difference are on, in two folds. One of the fold is the convenience to the users, that easy to find via, app and GPS, and also easy to identify where the scooters are, unlock in a split of a second, and they're on their way. We sometimes joke about it, but it's real. This is the closest thing to a magic carpet that you stand on it, it takes you to where you want it to go. And then the other part really is the data and also the algorithm we have in the backend really drive the efficiency of operating this kind of business. Without that part, that it cannot be sustainable.
I like that magic carpet phrase. I'm going to use that. I want to talk a lot about the heart of your mission, which is getting around climate change.
Yes.
How do you respond to critics or researchers that say some of the claims about being environmentally friendly are maybe over-exaggerated?
I think there are different measures on the benefit to the environment. One of that is clean energy. We're a company that first probably in the whole category that committed 100% renewable energy to power our fleet. I think that's very obvious, right? The second part is the indirect impact we're making. Out of the 100 million rides that we generated, which goes around the global for 4,000 times, right? That we estimate also cut 25 million car miles, and that's significant reduction in terms of the otherwise being, pollution goes into the society. The third thing that I would mention is that it actually shifting the pollution from the city urban core, where the highest density population is, to somewhere else.
Thank you. That was Brad Bao, co-founder and CEO of Lime. And that does it for this edition of Bloomberg Technology. Bloomberg Technology is live streaming on Twitter. Check us out at Technology. And be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.